Hi, Larissa. Thank you for attending and speaking to us today. Um, this is Larissa Greene. She is the Director of Education and a member of the Business Development team at Vanna IRA. She educates potential and current clients on the newly limitless possibilities for self-directed IRAs and the few rules for investing in alternative investments in regard to the IRS Section 4975, which is prohibited transactions and disqualified persons. She lectures to investors and professionals, as she actually had today she was in our area, Sarasota, Florida, at the RIA group speaking, and she's been doing this for over 11 years. She's prestigious and designation of the Certified RIA Services Professional from the American Bankers Association, and teaches classes used for continuing education for this designation as well. Thank you so much, Larissa, for attending. It really means a lot to us and taking time out of your day to talk to us about different types of self-directed IRAs and the new rules and the changes that are coming forward.
Yeah, thank you so much, guys, for having me. Is it okay if I share my screen?
Absolutely. I think, do I have to make you a co-host to share your screen, I think?
Mm-hmm.
Okay, try it now. See if you can.
Got it. Okay, perfect. Thank you. Okay, so I put some slides together for you guys, and I really sort of was looking at maybe what would be important for you, because I know there's going to be a lot of multifamily people on here, but also the information for a self-directed IRA can be used in so many different ways. And so what I try to do in the slide is show you guys how this information can be used, even if you're not ready to self-direct for yourselves. So for example, capital raising, and we'll talk about that, and just the overall strategy that people use for self-directed accounts. Now, when we talk about self-directed accounts, of course, we're talking about very specifically using money to invest outside of the market. But how else can you use this information? I'm going to talk about making your annual contributions and getting some tax deductions possibly, or making contributions that will grow tax-free. And so it's not going to be all about specifically the self-directed strategy, but also ways you can use this information outside of self-direction as well. If anybody has any questions, I would encourage you just to unmute if that's okay with the group and ask the question, because it's always beneficial to the group, because a lot of times people have those same questions and they're maybe nervous to ask it, and I'm happy to answer those questions as we go. So here's some information in order to contact me. So if you do feel like your question is maybe a little more personal, or you have a strategy that you want to talk to me about, we can always do that offline. Here's my contact information. You can call me directly or send me an email. And we have a lot of really great information at our website as well. So if we talk about a type of account, but you want more information, you can always go to the website. We have lots of information about different types of accounts, different types of investments, and there's also always education going on. Just a little bit about the company that I work for. Advanta has been in business for over 20 years, and we've always been the same people doing the same things. I actually have been with Advanta for a little over 12 years now, and I started in the back office, so I helped people open accounts. I did transactions, so helping people make their investments. I have also done check coding, so money comes in. How is that being credited to an IRA account, maybe as interest income, rental payments? It could be something like dividends, for example. I also help pay expenses on behalf of IRAs and handle money coming in and out. So I've done a little bit of everything at my time with Advanta, but I've been teaching classes for a little over 10 years now. And not only do we do, of course, stuff on Zoom, but like Sharon was saying, I was visiting a local RIA group today. I also sponsor weekend events and things like that. So we're out there just trying to educate, because simply people don't know they can self-direct. So that's sort of our goal. We have $2 billion in assets under management, and we can help people not only local to our offices, which are in the Tampa Bay area of Florida and also Atlanta, Georgia, but we have clients worldwide and also nationwide, or excuse me, nationwide and worldwide. So if you have a US-based retirement account, you can self-direct it. It's just that simple. Now, if you have like an employer plan, that's a little bit different, and we'll go into that in just a minute. So I'm going to talk today about what you can do and what the IRS limits for contributions are. But if there is a specific tax question, if you're looking for investment advice, or you're looking for some consultation on an investment you're doing, that's something that Advanta actually doesn't handle. So we don't do any tax, investment, or product advice. But if you have a question specifically to an investment you're looking at, we might be able to refer you to some professionals that can assist you that have helped our clients in the past. But more specifically, our questions are for our seminars and webinars are for educational purposes only. And you'll see there's going to be a lot you can learn by attending our weekly webinars. And we usually do 2 a week. So what is a self-directed IRA? And I think I get this question a lot because I know brokerage firms offer a self-directed type of account as well. But what's different between what we do and what they do is they actually do sell stuff. So they sell you just different types of investments. They give you a list and say, hey, you can make these investments, choose from the list. But their self-directed account basically allows you to choose how much you want to invest in which products they offer. So it's just a little bit different than what we do, where we don't sell you anything at all. We hold the account and provide a service. You find the investment, we help you get it done in the name of the retirement account. And we don't hold anything that is market-based at all. So when we talk about the different investment types and strategies available to you, you're going to see it's nothing market-based. We do hold stock, but that's going to be something that is considered private. So startup banks and restaurants, breweries, local companies, those are going to typically be considered private stock. And so we can assist you with those, but we don't handle anything market-based at all. So a truly self-directed IRA, in our opinion, is going to be something that holds things outside of the market, private investments, and that includes real estate, private placements, precious metals, futures trading, and really the list goes on, and we'll talk a little bit about that as well. So what can be self-directed? Well, traditional and Roth IRAs, those are going to be the most common types of accounts that we open. And you don't have to start fresh. You're not opening an account necessarily just to make your annual contribution and find investments. You can transfer between IRA accounts as often and whenever you like without penalties and without taxes paid. We're just going to move you into a type of account with us that you have with another brokerage account or custodian. And so if you have a traditional IRA with us, it'll just be a traditional IRA coming over from them as well, or Roth IRA or what have you, so that there are no taxes or penalties paid. If you have a former employer plan that you want to move over, we're going to open the type of account that makes the most sense for you. So if all of your money with your old 401k is pre-tax, then you could have a traditional IRA with us, which would be pre-tax, so that you're not paying any penalties or taxes for moving that money. If you are moving from an old employer plan, but now you're self-employed, we can look at a SEP IRA, a simple IRA, or a solo 401k, where you can hold that money and make larger contributions on an annual basis in order to help yourself and your business save for retirement. If you have a current employer plan, so if you're like me and you have a W-2 job, you work a 9 to 5, and you're making contributions to an employer plan, you may or may not be able to move some of that money to an IRA in order to self-direct it. So you would have to check with the plan administrator and see if the plan allows it. And all you're asking there very simply is, can I take any of this money and move it to an IRA? That's all they need to know. And usually the answer is going to be dependent upon how long you've worked with the company and what their company plan allows. And we also can help you with self-directed health savings accounts and education savings accounts. And even though these aren't IRAs, the rules for self-directing them are going to be exactly the same. And so we hold those accounts for you as well. I'm going to talk more about the plans in just a little bit, but I wanted to give you an idea of what can be self-directed, because for whatever reason, a lot of times I hear, well, I don't have a Roth IRA, so I can't self-direct it. And that's just simply not true. I'm not sure where that comes from, but that's why I like to start out with the types of plans. And usually what I like to say, if it ends in IRA, it can be self-directed. And there's so many other options as well. And another thing, just going back to the plans for a second, is some of these plans will work together as well. So if you are self-employed, for example, and you want to have a solo 401k, that doesn't mean that you can't also have a traditional or Roth IRA and make contributions to both. And you can also still have a health savings account if it makes sense and your plan, your medical plan allows it. You can also have an education savings account for dependents. things of that nature, and other children as well. We'll talk about that. But a lot of these accounts can be combined and work together, and some of them you can have, but you can't make contributions to all of the plans or max out all of the plans. So there's some things to note, but mostly my point being that some of these accounts will work together. And so if it makes sense for you to have a few different types of accounts, you can always talk to me about that. So the different types of real estate assets that we see most commonly are listed for you here, but this is by no means a definitive list because the IRS does not provide us with one. They don't say, here are the only things that you can invest in. And so I like to give you an idea of what you can invest in, but if you have other ideas outside of what you see listed here, it's very possible those ideas are allowed as well. But single family, of course, and that could be long-term or short-term rentals. It could be rehab projects. They don't have to be single family. It could be condos, mobile homes, or even mobile home parks, something that you purchase off a tax deed sale, real estate investment trusts, as long as they're considered privately held, syndications and private placements, of course, commercial property, and multifamily. And we'll talk about the different ways we see people invest in all of these things in just a minute. The paper side of real estate would be things like mortgages or deeds of trust, purchasing tax liens and tax deeds, like I mentioned, unsecured notes. And I know a lot of times people will say, I just would not feel comfortable with that. And, I might agree with you, but I do have clients that invest in notes that are considered unsecured. And of course, they're not always lending just to individuals, but maybe to businesses as well. Convertible notes would be sort of in that line too, where maybe they lend money and at some point that loan is going to be converted to stock in the company. We do see debenture notes, option contracts, assignments, joint ventures, and accounts receivable, all of this in an IRA. Did somebody have a question for me? No? Okay. And then we have other types of alternative assets, and some of these are going to be more common and then some less common. So we do see a lot of investments into LLCs, whether that's for partnering, for having checkbook control, maybe you're investing into a business. All of those things would fall under LLCs. Sometimes they're LLPs, and the list goes on and on there. We also see people invest in farm animals, farm equipment. They might lend money secured by farm animals or farm equipment, something we have seen often in the past. We see partnerships, movie projects. I actually spoke at a film festival in Orlando, Florida, a couple of years ago because we did have a movie project here locally in the Tampa Bay area that was raising capital. And we had a number of IRAs make that investment. And when I mentioned that at another seminar, a woman happened to be putting together a film festival and asked me to come and talk about that so that people that are working on movie projects could actually learn how to raise capital using retirement funds. So that was a fun one to do. And I learned a lot about raising capital myself for movie projects because people came to talk to me and said, I didn't know that I could do this. I didn't know that I could offer this. And this is the project that I'm working on. So that was a lot of fun. We see people invest in precious metals, so gold and silver bars and coins, platinum, palladium, and the IRS does provide us with a list of precious metals that you can invest in, so you can check out their website for that. We see equipment leasing, and I mentioned farm equipment, but it could be large format printers. I've seen people actually do loans for cars, for example, or 18-wheelers and transportation companies. We see Forex accounts, and if you're not familiar with that term, it's foreign currency trading. Private stock, as I mentioned, commodities, oil and gas, and all of these things, again, would be something that would be considered privately held. And again, this list is just to give you an idea of the things that you might want to invest in or kind of get your wheels turning of investments you can make, but it is not the definitive list. And because I'm in this business, I think of these things all the time. I might be out and I hear a commercial on the radio. And so, for example, I heard of one where basically you can invest into a frozen yogurt stand. And as long as you're not responsible for the day-to-day and things of that nature, it might be an investment you can make. And so that kind of stuff always pops into my head. Well, that might be something you can invest in. And we've seen clients make investments using their creative side as well. We have clients that own shares in sports teams and in airplanes and racehorses. And we actually do a webinar on that. We have that coming up soon. So it's a really fun one to hear because you get to hear how creative people are and how they're putting their money together and having it grow in their retirement account. So we just talked about things that you can invest in, but what about raising capital? And raising capital with IRAs is something that we do see a lot of. A lot of people that refer investors to us are just very simply capital raisers. And so they're sort of partners in self-directed IRAs because they use our service to offer another option to their investors. So it's a good tool in your tool belt, so to speak, when you're raising capital, because oftentimes retirement accounts tend to be the most liquid asset that people have. When you think about personal cash, it tends to be tied up. So whether it's tied up in our day-to-day lifestyles or our living, or if it's invested, a lot of times it's invested in illiquid assets, but our retirement accounts tend to be stocks, bonds, and mutual funds, things that we can cash out of very easily. And so when you're raising capital, consider offering that, because very simply, people have the ability to liquidate assets in just the amount that they want to liquidate in order to invest with you. You also have the ability to work with investors on a repeat basis. And so if they say to you, hey, I'd love to make that investment, but I just can't right now because all of my money is out. If you said, hey, did you know that you could use a retirement account to make this investment? That is going to unlock another source of capital. And, people are really looking to diversify. So we are all sometimes on that roller coaster ride in the market. And when you're looking to truly diversify and get outside of the market, then having a self-directed account offers that opportunity. And because it's not an all or nothing strategy, you can let people know, hey, I'm raising capital. The minimum is 25,000 or the minimum is 50,000. And that will give people the opportunity to cash out just the amount they need to move over to a self-directed retirement account to make that investment with you. And honestly, there's a lot of money in retirement accounts, and most of those retirement accounts are not self-directed. So it kind of gives you the opportunity to talk to people about retirement accounts and let them know that this strategy is available and therefore may help you raise more capital. We worked with a company several years ago that was raising capital, and one of their principals just happened to have a self-directed IRA, and they reached out to us and said, how do I let people know that they can make investments into what I'm offering through an IRA account? So we gave him a blurb to include in his email campaigns. And oftentimes people that were already making an investment with private or personal funds decided to also make the investment with some portion of retirement funds, and therefore just was helping him raise more capital. So that also was a lesson for us in helping people sort of get that message out. And so we do, if you are raising capital, we do infographics for you at no cost, private landing pages, and flyers to help you basically say, hey, did you know you can make this investment with me with a self-directed retirement account? Also, when you're raising capital, it can be in many forms. So you can borrow money. It could be short-term transactional. It can be equity participation, but also something that in the multifamily world, you guys probably use more often would be something like syndications and limited partnerships. But all of these will work for a self-directed retirement account. So just keeping that in mind, that if you're not necessarily looking to raise millions of dollars, but you just have one project that needs short-term money for whatever reason, it can be something where you work with a single individual, maybe for a private loan that is, 2 months, 3 months, 6 months, a year, 5 years, whatever it might be. As the IRA holder, they get to set the terms, and so they can work with you within the time frame you're looking for. So I wanted to start out with some case studies to show you guys how this will work, and then we'll go into the technical side of self-directed IRAs. And before I go on, does anybody have any questions for me? No? Okay. So with this first case study, we're going to talk about funding a rehab project with a private loan. And like I said, if you're raising capital or you're looking for private money, it doesn't have to be a limited partnership with general partners and a large project raising millions. It can be a smaller project, maybe not necessarily a couple $1,000s, but maybe $100,000 or $50,000, but it doesn't have to be millions. And so when we're talking about that, usually it's a private loan. And so the way that it would work is the IRA holder would establish an account, fund that account, and then we help you get that investment done. We do not provide investment documents. And so as we go through this example, you're going to see that the documents are provided, by the borrower or the lender, but essentially we look to make sure that the IRA is properly titled as the lender in this scenario. We have the IRA holder approve it, and then money goes out based on the transaction. So Bill and Stephanie are working together on Stephanie's deal, and Bill bought a house to flip and needs a private investor for some cash to fund the rehab. He knows Stephanie, they work together. They went to school together, and he decides that he's going to let Stephanie know that he's looking for money, and maybe she doesn't have the personal cash, or maybe all her personal cash is tied up. But if he lets her know that she can use a retirement account, this might be something that she does decide to do. And so in this scenario, they work together to decide how much Bill needs to borrow and how much Stephanie is willing to lend. She's going to do her due diligence, not only on the project, but maybe on Bill. You know, in this scenario, they know each other, but what if they met at an investment club meeting, for example? Then she wants to make sure that she is comfortable with the investment and comfortable with the person she is investing in. And that's very important because Advanta IRA does not do any due diligence for you. We don't guarantee or insure your investments, and we don't do any due diligence on the people you're working with. Our role really is just bookkeeping for this investment. So you want to make sure that you feel comfortable with the investment that you're making. So they work out loan terms. And the really cool thing about private lending is that you actually get to be the bank. So you're the bank in this scenario. And what does the bank decide? The bank decides the loan terms, interest rate, payment, how long the loan is good for. Is it a balloon? Is it interest only? Is it amortized over however many years, months, whatever it might be? And so when you are the bank, you get to determine all of those things. And when you lend money out of your IRA, you're really determining the rate at which your IRA is going to grow. So it's a really cool strategy. Titling the document. So again, the note and mortgage or deed of trust are going to be in the name of the IRA as the lender. So Advanta IRA, FBO, Stephanie S, IRA number 1234. When Stephanie turns in these documents and we talk to her about the name of the lender, she has also the option of either leaving her name off or her IRA account number. She just has to have one or the other. And so if you decide that you would like some anonymity and you want to leave your name off, you can do that. If you prefer to leave your account number off, feeling maybe that's a little too personal, you can do it that way as well. Documents are provided by either the borrower, the lender, the closing agent, the title agent, the closing attorney, whomever might be putting those documents together, just not provided by Advanta. Stephanie's going to make sure to get all those documents over to us, and she's going to let us know who we're working with. So if it's being closed by an attorney, she would give us that information, and then we work alongside them to make sure that everything is done by the day of closing. And we send all of the documents to Stephanie for her to read and approve so that we know she's viewed the documents, made sure that they are accurate to what she agreed with Bill. We have her sign off on those through DocuSign. And then once we get the approved documents back from her, we're going to work with the agent for closing. In this example, the loan amount will be $50,000 with an interest rate of 5%, and they agreed on 25% of the profits back to Stephanie's IRA with a 1-year balloon. And Stephanie gets a first mortgage on the property, so she gets to be involved in real estate, but she doesn't have to deal with the rehab, and she's not dealing with tenants, toilets, and termites. On this side, Bill is going to have his attorney prepare the note and mortgage, turn it into Advanta. All the information, again, is read and approved by Stephanie. And once the money goes out, the note is held by Advanta, and payments are made back to Stephanie's IRA with Advanta. So I always like to say that your IRA is sort of like your business partner, because sometimes people say, well, once the money goes out, the loan payments come back to me, right? Because it's my IRA. And that is not the case. You want to think of your self-directed IRA as a separate entity from you. And more commonly, we think of stock. So when stock gets purchased in your retirement account, it's purchased, it's held by the retirement account, and any growth is realized by the IRA and not by us personally. And that's the same with a real estate investment. So even though this is a little bit different, it is held in the same way. It's held by the IRA. The growth is received by the IRA. And if it were a rental property, for example, and there was any expenses, those expenses would be paid by the IRA. So that's super important to remember. In this example, the loan is ready to be paid back when the project is complete in 6 months. And Bill is going to work with Stephanie for the payoff amount through the title company or closing attorney. And any earnings will go back to the IRA tax deferred, or of course, if it's an after tax account like a Roth, it would go back tax free. And here is sort of the breakdown of value for both Stephanie and Bill. And I think this is important because, again, when we're talking about maybe being on the other side and raising capital, you want to see that just knowing about self-directed IRAs and having that tool in your tool belt can be a really big benefit to you. And so Stephanie's value, of course, is that not only was the principal repaid, but she had monthly payments totaling about $1,600. She got her percentage of the profits, which was $10,000. Her money went back into the retirement account, and now she's ready to make a new investment. And Bill had the benefit of borrowing the money, making the payments, and getting his project finished in a timely manner because he had the money for the rehab. Investment forms for a self-directed IRA are going to be the same forms you guys are already used to dealing with. And so that's going to be a subscription agreement if it's, some sort of syndication or private equity. It could be a limited partnership agreement. There could be loan documents. It could even be if it was private stock, then there would literally be a stock certificate and a purchase agreement. So there, any of the investments that you're already familiar with making, the IRA makes them in the same way. But instead of being in the name of you as the personal owner or investor, or maybe even your personal LLC, everything is going to be in the name of the IRA. So you can see the second line here, as we talked about with Stephanie's IRA, Advance IRA Services LLC for benefit of the client's name and account number. Advance IRA is actually the legal signer for your IRA. So although we have the client read and approve with their signature, showing that they reviewed all the documents and they're agreeing to that investment, if there is a reason for the IRA to sign, then Advanta signs on behalf of the IRA. So maybe not as much in the case of an IRA lending money, but in the case of an IRA buying real estate, investing into a limited partnership, purchasing stock, the counter signature would be by Advanta IRA. And we have the client complete a form for us, letting us know who we're dealing with for this transaction. And then once all that's done, we'll sign everything and send money out for that investment. Does anybody have any questions before I go on to the second case study?
I'm interested to know how many people have a IRA in this group. If you raise your hand on your. We have, David Allen has one. Okay. I was just curious how many actually had that.
So the next thing we're going to talk about is investing in a multifamily syndication. And I think this is important, because I know a lot of you are multifamily investors, and whenever you're talking about making an investment through your retirement account, there are some things with a retirement account that you should be aware of when making that investment. And multifamily, or a syndication, a private equity, or investing directly, they're all going to have just little nuances. So when you make an investment directly and you're in control of that investment, like Stephanie loaned money to Bill through her IRA account, that's pretty straightforward. But when you're making an investment into real estate or into a business, there are some moving parts in there. And so when you're talking about multifamily investments, somebody else is in control of that investment and you're just a small part of that investment. Your money's being pooled for a certain purpose. And sometimes that purpose will have more moving parts to it than when you're investing directly. So Jane and John have a deal that Jane is interested in, John is interested in, and Jane is raising capital. And she needs to raise $1 million in private funds to close on an apartment complex that she's looking at. And so she's raising capital through private investors, and she is offering the ability for people to make that investment through retirement accounts. So once John does his due diligence on Jane and her investment, he decides he's going to use a self-directed Roth IRA. Now, I'm using this example specifically for a reason with a Roth IRA, and you're going to see why that is in just a minute. But basically, the subscription agreement, the limited partnership agreement, whatever it might be, is going to come to Advanta, and it's going to show the IRA as the investor. So instead of John personally, it is going to show John's IRA. I know I'm going to get the question about accredited investors and who fills out that questionnaire. It's still going to be the client, because that is based on your personal information and ultimately whether or not you can make the investment. Not all syndications, just so the group is aware if they're not already, are going to be requiring accredited investors, but that requirement has nothing to do with Advanta. It's specific to the investment that you're making and the investment provider. So you'd have to check with them on that. But the limited partnership agreement or the subscription agreement is going to be completed in the name of the IRA. So just as we talked about before, Advanta IRA for benefit of John Smith's IRA number 1234. It's going to be the tax ID for Advanta, not John Social. Very important. And Advanta will sign the subdocs and send out the wire once John approves everything. Jane sends $2,000 as quarterly dividend payments back to John's IRA. And after all the units have been updated, Jane refinances, pays back the investors, and they also get a share of earnings. And so that seems very straightforward and something maybe some of you guys have done. Maybe some of this sounds familiar as an investment you have made, but there is something else to be aware of, and that's called unrelated business income tax. How many people have heard of unrelated business income tax? Is anybody in the group familiar? Okay, few of you have heard of it. That's good. So when you invest in real estate and that real estate is going to have debt, whether you're purchasing it with debt or you're refinancing it with debt for the rehab or whatever it might be, if there is debt when real estate is being purchased, unrelated business income tax will apply to IRAs making that investment. And it doesn't matter if my IRA is, let's say my IRA is buying 123 Main Street, and 123 Main Street is $350,000, and my IRA is purchasing it with $200,000, and I'm using a $150,000 loan, then UBIT or unrelated business income tax is going to apply. If I'm investing with Jane and I'm using $100,000 of my money as a limited partner into this investment, and Jane is using financing, she's raising equity and then she's using financing for the remainder of the purchase. Limited partners that are IRAs are going to be exposed to this tax because of the debt. And I think sometimes people are not aware of that. They think because they're a limited partner and they're not really controlling the deal, that unrelated business income tax does not apply. And unfortunately, that is not the case. Now, there are ways to mitigate this tax. One of them is just simply if you are eligible to or able to make the investment through a 401k, the 401k is not exposed to UBIT in the way that an IRA is. So UBIT applies either in the financing scenario for real estate or when you invest and business income is being received by the retirement account. If it's a financing scenario, the 401k is not exposed to it. If it is a business income scenario, then the 401k could be subject to it. But so just so you're aware, if you are a limited partner with your IRA and you're making this investment and the general partners are using financing for that real estate, then UBIT is going to apply. If you're using a 401k or a solo 401k, it doesn't apply. And so a lot of people sort of look to ways that maybe they would qualify for a solo 401k so that they can make this investment and not owe the tax. And I'll just tell you, I can't qualify you for a solo 401k in any way. That's a question you want to have for your tax provider or your tax professional, because I can't answer that for you. But we can definitely talk about what might qualify you, and then ultimately you have to make that determination. But another way to mitigate that tax would be to use a C corporation or a C blocker, sometimes people call them, where you'll pay tax at the corporate rate instead of at the unrelated business income tax rate. But even if it applies, is it so horrible? And the answer is it's going to depend. And that is going to be a question only you and your tax professional can answer. But here, the way that it works is that the IRA does pay the tax, so it's not a tax burden to you personally. The IRA does get to take deductions. So as a limited partner into this investment, you want to talk to the general partners and find out what deductions you're going to get every year when you have to do the calculation for the tax. And the tax is only on the income related to the debt. So I want to say that again for emphasis. it is only on the income related to the debt. So if I make that same $100,000 investment with Jane, it's not my $100,000 that is going to be affected by this tax. It's going to be the income being returned to my IRA that is going to be affected by the tax. So that's really important. And if Jane, in our example earlier, is going to get 50% financing, then it's going to be 50% of my income that is going to be affected by this tax. And I will still get to take deductions. So although 37% does sound scary, I would run through some sample calculations with your tax professional to find out if that investment still makes sense for you. Because with some deductions and stuff, you might not feel that it is as scary as it sounds. And also, of course, the years that you receive some sort of preferred return or dividend, you're going to pay less in tax than at the sort of the final payout, right? Because that typically tends to be the bigger payout with a multifamily investment. And then at the end, and I don't know, if that changes sort of the way you look at the tax, or maybe look at one of the ways to mitigate that tax, but it's something to keep in mind. And I do have sample calculations that I did not include in this slide deck that I'm happy to share with you. So if you do want those sample calculations, just send me an email and I'll get them over to you. But that's a little bit about unrelated business income tax. So whether you're looking to make a limited partnership investment, or you're looking to raise capital using partnerships, just be aware of that so that your IRA investors can get a heads up and talk with their tax professional about it. Does anybody have any questions? No? Okay. Frequently asked questions: are there taxes owed when I move my money to a self-directed retirement account? And the answer is no. If we move your money to a like account, then you will not pay taxes or penalties to do that. And I think that's a big question we get. And do taxes apply to investment earnings? And that's why we talked about the U-bit. And you know what, I forgot to mention it, but remember in our example, we were talking about using a Roth IRA to make that limited partnership investment. And the reason that was important is because that unrelated business income tax does still apply to a Roth IRA. A lot of times people will say, but it's a Roth IRA, it's tax-free. And unfortunately, it's the earnings we're talking about here and not the IRA itself. And so the earnings are still going to be taxable if that financing scenario does apply. So just keep that in mind. So do taxes apply to your investment earnings? Sometimes. Depends on the structure of the investment. Is this a loan from my IRA? I get that question all the time. How quickly do I have to pay it back if I make a private investment or if I buy real estate? This is not a loan. It's an investment of the IRA, just like you're familiar with when you buy stock in your IRA. That's an investment of the IRA, just like this is. This is just something maybe a little more uncharted or something you're not used to seeing. But the good news is that is what we are used to seeing. That's all we handle are private investments, and we're going to walk you through it. Do I get personal income from this investment? The answer is no. It's still a retirement account. The growth is still for your retirement. So again, whether it's stocks, bonds, mutual funds, real estate, precious metals, or limited partnerships, their growth is for your retirement. There are some rules. So we talked about things that you can do, investments you can make, structures that will work in your IRA, but there are a few things that you should be aware of. There are two prohibited investments, and that's life insurance and collectibles. So those are investments you cannot make in a retirement account, or I should say specifically an IRA. I know some life insurance policies or options are available for 401ks, but that is a very specific strategy as well. It's not something that you can just go and do. You have to make sure that it's a structure allowed within a 401k, but for the most part, life insurance is not allowed in retirement accounts, and neither are collectibles. You cannot engage in a prohibited transaction. So you cannot transact with yourself as the IRA holder, your spouse, or anybody up and down your lineal tree. And then we also talked about when tax might apply. So business income being returned to an IRA or 401k, or if there's financing being used to purchase real estate when it comes to an IRA. Here's a table for you to show you those disqualified persons. So people up and down your lineal tree, and that includes yourself and your spouse. So yourself, your spouse, your parents, your grandparents, your children, your grandchildren, and any spouses or business entities of those. And so a transaction would be buying, selling, leasing, lending money to those individuals, trading goods or services, things of that nature. And so basically the IRS is saying here that they want to see transaction be at arm's length when it comes to your retirement account. So that's very important. Who is not on this list? Does anybody see who's not on this list?
Siblings.
Brothers, sisters, that's right. Siblings, brothers, sisters, aunts, uncles, cousins. Those people are not considered disqualified when it comes to transactions. However, I would recommend very strongly talking to your attorney or getting an attorney's opinion on those transactions, because if they become if there's an intrinsic value to you for making that investment, now it could become prohibited. So again, no current benefit to you for an investment. And when you're investing with a brother or sister, for example, there could be some intrinsic value there. And the example I always use is if I had a rental property in my IRA, let's say, and my brother needed some place to stay, and he was like, I'll pay fair market rent. I don't have any place to go. And I say, well, gee, I need to put my brother in that property or he's going to end up living with me. That could be some sort of intrinsic value. And it sounds silly, but those are the sort of gray areas that we want you to be aware of. So transaction basics, just we talked about this, just making sure everything's titled in the name of the IRA, that you don't sell, transact, trade goods or services with anybody considered disqualified from you. Remembering that your due diligence is up to you, so feeling comfortable with your investment, making sure that you read and approve all of your documents and turn all of your documents into Advanta so that we can help you with your investment in a timely manner. Remembering that your IRA pays all of the expenses related to that investment and receives all of your income. And that when you're partnering, you're making sure you understand the rules for partnering. So even though we said you can't transact with people considered disqualified, you can partner with them, but you need to make sure that those investments are being done based on percentage of ownership and the amount of money being brought by each of those disqualified persons, and that those percentages remain the same for the life of the investment. Do you have any questions? Jane, Sharon, did you want me to take a pause? Because I know technically the group changes a little bit at 7:30, so I kind of broke it up into two sections.
Oh, can I ask a question?
Maybe we can see if people have questions or,
Maybe we can force them to have.
yeah, Jane said we should force people to have questions. And I know a lot of people did not raise their hands that they, have a type of self-directed IRA, so this might be new information to them, so they might, need further.
So I have a
explanation.
question.
Go ahead.
In multifamily investing, particularly in joint ventures, there are some issues with IRAs because of the nature of a joint venture. Can you talk about that a little bit?
A little bit. Ultimately, I usually defer to your attorney, so whatever the attorney is comfortable with. But if you're involved in a joint venture, typically what we see on the IRA side is something very passive. So you might say, okay, well, your interest rate might be a little lower, but then I want a percentage of the profits, or maybe the purpose of the the joint venture is because the IRA holder is willing to go without payments or whatever it might be. But the IRA holder still has to be in a passive situation here because they can't go out and swing a hammer or provide sweat equity on behalf of an IRA investment. And so you do want to be careful with that. I'm not sure if that was your question, or do you maybe have something more specific you were thinking about?
Well, by the SEC definition of joint venture is that people, all partners, have to be equally involved, not only so they have to be working on the deal as well as putting money into the deal. So they can't be passive by their nature, by
Okay.
what the SEC says in their own paperwork. And so that always makes it a kind of an iffy kind of thing with investing in joint ventures through your IRA.
Mm-hmm.
So,
Yeah, because I think we typically are using that term a little looser, meaning, that there's some equity, involved in, the return or something like that. But if you're looking at the SEC definition, then I would say, the IRA holder would definitely want to get a legal opinion based on how much they're being a part of versus everybody else, of course. So if everybody else is, handling it in a specific way that an IRA holder maybe could, then that might be okay. But this might be definitely a time where you want to have an attorney's opinion and make sure that you're not providing any sweat equity. So for example, I talked to a gentleman that owns a company that does surveying, and he was going to buy a property, and in sort of a joint venture capacity where his company was going to be involved to save the venture on the surveying, and there was going to be quite a bit of surveying. And, I told him, unfortunately, your company can't be involved. That isn't going to work for your IRA, because even if you're not the one out there actually doing the physical labor, it's going to be an issue that your company is involved. And so he decided to make that investment personally instead, because it just wasn't going to work for the IRA. And so that is definitely something where if you have to provide some sort of sweat equity because of the SEC definition, then I would get an attorney involved, because that might not be something you can do with an IRA.
If people are considering getting an IRA, which I strongly suggest, why would they turn to Advanta? Why would they pick your custodian?
So I think the biggest thing is if you're ready to self-direct, if you're ready to put on your entrepreneurial hat and find your investments, then we would be a very good fit. If you are not sure of the investment that you want to make and you're still learning, then I think we're a good fit for education, because there's no cost or no obligation to our education. So I would strongly recommend that you join our website, sign up for our email list, and get involved in our education. But if you don't have an investment, you're just looking for an annual contribution, just keep in mind that Advanta only earns money because we are fee-based. And so there is a fee to set up your account and hold your account with us. And so if you don't necessarily have an investment in mind and you're not ready to self-direct, it might not be a good fit. When your cash sits with us, it doesn't earn. And so that's why I said you really have to be ready to look for your investment and get your account growing and be an active participant in finding that investment. If you are ready to start looking for an investment, then definitely get your account set up so that your cash is ready and available when you find that investment. Because if you're going to do, a deal over a handshake and a cup of coffee, then you want your cash ready to go so that we can close in a day, in a week, or whatever it might be. But if you're not ready to start self-directing, then we would love for you to join us for education, because I think that's important too.